Goeiedag, good day, fellow South Africans and citizens of the world.
I've been looking around for salvation. I've been looking around for the truth. All around me I see frustration, and I looked all over till I found you. I sit and listen to your stories, and you're telling me, please don't worry. A lot in this world you should know, and love in life is where you should go. If you're looking for somewhere to go, if you're looking for someone to know, if you're looking for someone to guide you, then love in life will guide you.
Goeienaand, good evening, fellow South Africans and citizens of the world, and welcome to tonight's very special live stream. Well, it's been a couple of weeks since I've been on, and I've had a ball in South Africa, I have to tell you. And Mark, if you have a look just up there, you will see a permanent new addition to the Loving Life background, which is that Pog Mahorn sticker, which Marlena kindly gave to me when I was in South Africa. And yeah, I think it's quite relevant when we have some topics that we remind ourselves that there are some people in South Africa who should be pogging all our horns. Now, tonight we're talking to Dawie Roodt, and of course I was in South Africa, and Dawie very kindly invited me to his home, and a beautiful home it is in Pretoria. And, well, here goes the interview, which is split into two parts. The second part is tomorrow night, where we talk about the future of money, and we're going to be talking about everything from non-fungible tokens, can you believe it, which is a form of money, according to Dawie, and, of course, central bank digital currencies and PayShap and all these different things that are coming out for the one world government, which is a subject that Dawie still doesn't believe in, but we're starting to get through to him. I actually sent him a copy of the book, The Great Reset by Klaus Schwab, and I said I think he would find it of great interest. All right, guys, I've been burbling on enough. Let's go straight to Dawie Roodt, the interview, and part two, as I said, is tomorrow night. And finally, Monday night, I'm going to be talking about my time in South Africa. So that's a live stream for Monday night, so watch out for that as well. All right, here we go.
Okay, cool. Hi, Dawie. Thank you so much for inviting me to your house.
Scott, you are very welcome. Very nice having you here. So
Fabulous.
In person.
Yeah, absolutely. In person in South Africa.
Yeah, it's always better in person.
Absolutely. And we're going to be talking about the future of money, not just in South Africa.
Looking forward.
Cool. Okay. All right. Dawie, we're going to be talking about the future of money, and not just in South Africa. But before we do, it would be, I think, really important for people who don't really or can't get their heads around money to talk about a bit of the history of money. in perhaps the last 120 to 150 years. And I think the first really pivotal thing that happened was on Jekyll Island in 1913, when people like J.P. Morgan had that secret meeting and they set up basically the Federal Reserve Bank. Do you want to start off by telling people about that and the implications of what happened?
Maybe, Scott, if you don't mind, maybe we can start a little bit before that.
Sure, go ahead.
So let's just see this thing that we call the economy, where it started. I guess, I always say that economics is not about interest rates or inflation rate or about money or about markets. Economics is only about one thing, it's about people. But still, there must have been some time in the history of mankind when everything started, when the economy started. And I think a good place to start the economy is when we first domesticated animals. Now, I think that's a good time to start, because when you domesticate animals for the first time in the history of mankind, a concept is established that never existed before, really. And that concept is the concept of private property rights. Now, this is very important because of the second reason why our economies evolved. And the second reason is that the economy is the second step in this thing that we call the economy was when people started to trade. So think about that. There's a saying in economics that says, there is no free lunch, but I disagree. There is one free lunch. And that one free lunch is when two individuals trade freely with one another, because that in that instance, both the buyer and the seller gain from the transaction. Otherwise, the transaction would not have happened. But before you and I can trade with one another, the concept of private property rights must be established, because I can't exchange something with you if I'm not the owner of that. So that secret ingredient in economic success, first of all, is the protection of private property rights, and secondly, the free exchange between individuals, trade between individuals, and a third very important one is, of course, sound money. But just go back a little bit. So we've established private property rights. We started trading with one another, but trade is a very cumbersome and a very expensive process, because if I have a cow and I want a chicken, I have to exchange my cow for 10 sheep, and I have to exchange 1 sheep for 10 chickens, and I have 9 sheep I don't want and 9 chickens I don't want. So clearly, trade is not a frictionless thing. It's quite expensive and it's very difficult to trade. You do create free lunches out of trade, but there are a lot of hiccups, and that's where money comes in. So money made this process of trade so much easier. So instead of exchanging my cow for 10 sheep, what I will do, I will exchange my cow for a piece of gold, and I will keep most of the gold in my pocket, and I'll break off a small piece of gold and buy a chicken. And I can leave the gold in my pocket and use it tomorrow or the day after, so I can save with the gold in my pocket. And that's the origin of money. So if we look at it from that point of view, the protection of private property rights, free exchange, free trade between individuals, and sound money, those three are the ingredients to a successful economy. But of course, money evolved over time, and as always, politicians or the authorities like to take control of money. And that's why during the history of mankind, whenever money was established, politicians or kings or rulers will have their little faces stamped on the coin, and they will say, I hereby declare this is 1 ounce of gold, as an example. Of course, they lied. They always lie. Because what they will do, they put a little bit of lead in the gold, or they will chip some of the gold off, and they will say, listen, this is legal tender. If this is 1 ounce of gold, but in reality it was a little bit less than 1 ounce, because they will steal some of this gold, and that was the income of the king. We call it signage. And even today, central banks make money exactly the same way. So that is the basis of money. And of course, money from then on, originally we started using all sort of things, but we settled on precious metals, and eventually we settled on derivatives of precious metals. Typically, for example, IOUs, which morphed into notes, and eventually notes moved into becoming electronic, An electronic money is nothing but a derivative of another derivative. And that's what we have today, mostly electronic money, which is mostly under control of a central bank. So there are many central banks in the world. The South African Central Bank, as an example, is just over 100 years old. The Federal Reserve in the US is less than 100 years old. The oldest central bank in the world is the Riksbank in Sweden. The second oldest central bank in the world is the bank in England, the Bank of England. So that is the second oldest central bank in the world. And basically what central banks do is that they are monopolies. Central banks have the right to issue money. They have the right to issue initially notes and coins. But today central banks issue money in the form of electronic form. So central banks are basically monopolies, including the Federal Reserve in the United States. And the thing is that the history of central banks are that initially central banks were privately owned. So typically what would have happened, and I think the French central bank is a very good example, Napoleon wanted banks to fund his war effort. But the banks didn't want to do that. Banks were privately owned then. So Napoleon said, listen, I'm gonna change the banking system. Nobody is allowed, previously all banks were allowed to issue their own notes and coins. Nobody is going to be allowed to issue notes and coins anymore. Only one bank will be allowed to do that, and that's the French central bank, provided they fund my war effort. And that kind of was the beginning of central banks. And since then, a lot of central banks have been established. But the important point is that central banks that are under control of the authorities are relatively new inventions. There are a couple of old ones. And most central banks are less than 100 years old. So central banks are actually new. Before we had central banks, most money was issued by private banks that issued notes and coins that was basically a liability on the balance sheet of those private banks.
Now, just to interrupt, you've got a very proud chicken that's just laid an egg.
Yes, is that a problem? Must I close the
No, that's fine. But it's private property rights. You've just got an egg.
I got They're very happy about it.
Okay, let's get back to central banks, because in 1913, as a result of that meeting, which involved J.P. Morgan and a bunch of other very, very wealthy people from the US, the Federal Reserve Bank was established. And also in that year, private taxation started as well, which had a huge impact on the wider population. Do you want to take us through that area leading up to, let's say, the Great Depression in 1930?
There are two very important things that we have to understand when you talk about. Perhaps what we should do is just to understand what we mean by this thing called the state. Or what you mean when you talk about the authorities, because there's a special relationship between the people and government. Mm-hmm. What is this thing that we call a government or a state? I think that's a good starting point. A state is basically an institution that monopolizes violence, because that is what the state is. When we think of a state, we typically think of a geographic area, and we call it a country with an army and a police force and a government and a constitution and stuff like that. All those things are true, of course, but in essence, a state or a country then is an organization that monopolizes violence. And the social pact is that this country will provide protection to the individuals. So, and I will not take the law in my own hands. I will allow the state, or then the government, the guys running the state on my behalf, I will allow them to monopolize violence, and they will use this violence to protect me. I, from my side, promise that I will fund the state. I will not take the law in my own hands. I will take some of my hard-earned money and I will give it to the state, and the state will run this thing, or the government will run this thing called the state, and they will protect me. So that is called the social pact.
Right.
Now I'm afraid, and I think South Africa is an excellent example, is that the South African government actually reneged on this social pact because they're not protecting us anymore. So I think we as the people in South Africa, we certainly do have the right to say, listen, but I'm not going to keep on funding you because you've stopped protecting me. So this thing called the state in South Africa, or South Africa in a way, has become illegitimate because the state is, or the government is just not doing what they're supposed to be doing. But I'm deviating a little bit from the point. So the important thing is here that, so the question we as a society that we need to ask is, how much of the stuff that I produce, how much of my production am I prepared to give to the state to protect me, first of all, because that's the primary responsibility of the state. But maybe the state should do some other stuff as well. Maybe the state should provide some infrastructure, maybe some education, maybe some health services, whatever the case might be. But that's a bit of an ideological question. And we're supposed, through the democratic process, decide on what the state is supposed to be doing. We all know they're supposed to protect us, that's a primary function, but maybe they should be doing more things. So that's a question on what they should be doing and who's going to pay for that. And that's usually the fiscal accounts or the Minister of Finance that's responsible for that. So the democratic process theoretically is supposed to determine who's supposed to be paying and who's going to get what kind of benefits. There's another variable in this that's very important as well, and that is the state is usually in charge of the money system as well. And since central banks are statutory monopolies, private sector banks are not allowed typically to compete with your central bank. Then central banks, and I know central banks like to think that they are independent. They're not really independent. They're basically under control of the authorities or under control of politicians. Central banks are supposed to be independent and only to look at one thing when it comes to money, and that's to make sure that money remains sound, or put differently, that inflation rate remains low. Unfortunately, what happens in practice is that politicians, as always, try to control the central bank, and they're doing it all over the place. There are many examples in the world. Argentina is a very good example. Turkey is a very good example. And what politicians typically would do is that they will get your central bank to create too much money, and in the process what happens, inflation goes up and the value of money goes down. And that is nothing but another form of tax. And there's a lot of money to be made out of making money. And central banks are very, very profitable institutions in the world. They make a lot of money, and politicians use basically this power to get central banks to make more money for the authorities, if you like. Then, of course, this took various different forms. In the case of the Federal Reserve in the United States, they had a number of private held banks, and those banks issued their own dollars. Many of them collapsed now and again. There were issues because if you have the banks got a particular kind of problem, because banks typically will borrow short-term money, and they will take the short-term money and they will invest it in longer-term assets. And when short-term interest rates go up and longer-term interest rates go down, typically banks will go underwater, they will go bankrupt. And the Silicon Valley Bank is the most recent example of a bank that went bankrupt. Now, the theory behind this is that we should have a big brother, we should have a central bank that will keep an eye on banks, because if one bank falls over, it pulls a lot of other banks down, and it's very disruptive to the financial system and eventually to the economy as well. And there are many examples of this, in fact, in the world as well. There's one major problem, and the major problem is when a central bank steps in to assist a bank that has just fallen over, it creates something that economists call a moral hazard. Because banks know that the central bank will step in and save them, banks now start taking unnecessary risks. But not only banks, depositors like you and me, we don't care where we deposit our money, because we know if the bank should go underwater, the central bank will also come and bail us out as well. So it's our fault as well, is in that we don't look at where we put our money, we don't care where we put our money, because we know Big Brother will come and save us always. So that is the moral dilemma of the whole system.
Can I just put a scenario to you? In 2007, 2008, Lehman Brothers went belly up because of the subprime fiasco.
Exactly the same situation.
Let me just... Okay, so you had a toxic asset, which is mortgages that weren't being repaid, and because of that, the insurance companies couldn't cover this, and then Lehman just went bang. Now, with the Silicon Valley Bank, which you referred to a moment ago, the reason they went bang was nothing to do with toxic assets. They actually invested in US government bonds at a very low interest rate. So when people who were depositors demanded their money, they were forced to sell those bonds, but because the interest rate had gone up to 5%, they only got a tiny percentage of the actual value of the bond, which caused them to go bankrupt. Now, we're talking about a very safe asset, which is US government bonds, which caused the Silicon Valley Bank to crash. So when you look at that compared to Lehman, how can fiat money be safe? Because all these things that banks invest in can actually cause them to fail.
No. What the big problem that you're making in your argument here is the time value of money.
Yeah.
All right, because if you invest in a government bond, for instance, a government bond will carry a certain percentage. When I guess when Silicon Valley Bank invested in bonds, they were probably trading at a yield of what, 2% or so?
1.5.
Probably somewhere there. And subsequently, the yield on government bonds went up.
Yeah.
When yields go up, prices go down.
Interest rates up.
When yields go up, interest rates, yields, that's important. There's a major difference here. So when yields go up on government bonds, so let's start beginning. So at Silicon Valley Bank, they specialized in IT. Their customers were IT people. So they had a lot of cash. So we'll take all this cash, and argument's sake, they took the money and they put it into, they took the short-term deposits at zero interest rates. Argument's sake. So it's more or less the same, but it's to make it easy to understand. So they took the short-term money that they got for free, basically. They don't need to pay interest on that. And they took this money and they buy government bonds that were trading at the yield of 1.5 or 2%. And they put that money in government bonds at 1.5 or 2%.
And the problem is 10 years.
The problem is those bonds will give you a yield of say 2% annually, but will only pay back the principal in 10 years' time.
That was the problem.
And that's the problem. If you want to sell those assets before they mature, before the end of this 10 years, you must be prepared to take less than 100% of the face value of those assets.
That's if the interest rates have gone up.
When the yields went up.
Or the yields went up.
So when the yields go up, so you can sell your $100 worth of government bonds, you can only sell it now for $80 as an example. In the meantime, you still owe $100 in your short-term deposits that you've taken in. So there's a 20% in this example, simple example, loss, and Silicon Valley Bank went belly up. Because there's a mismatch between two things, between short-term and longer-term deposits, and of course short-term and longer-term interest rates. If for somehow Silicon Valley Bank could survive for 10 years, nothing would have been wrong. Everything would have been hunky-dory, because after 10 years they would have gotten their money back, because of government bonds will still pay out $100 in this example. But if you want to sell it before the 10 years, you will be forced to take less than $100, and you will not be able to repay your short-term depositors.
Now, this is where it gets really, really interesting. As a economic expert, I'd like your comments on this. Last week, or the Friday that's just gone, Credit Suisse Bank had $54 billion pumped into it by the Swiss National Bank.
Francs, actually.
To try and, was it francs or dollars?
I think it's about 40 billion francs, so it's about $56 billion a year.
But the depositors in Credit Suisse Bank have said that's not enough, and they're still pulling the money out. And other banks are saying to Credit Suisse Bank, we're not going to accept your promises to pay. We want the cash. So despite over $50 billion being paid into the Credit Suisse Bank, they're on the point of collapse because of what's going on. And it's not just big investors, it's other banks that are putting the pressure on them. Now, as a result of this, the price of gold has gone shooting right up. It's nearly $2,000 an ounce. And I can see you smiling because I'm a gold bug. And
of course you're going to be a gold bug.
All right, tell us the the relationship between what's happening to the banking industry right now, and you referred to precious metals right at the very
Yes.
beginning, as the whole concept of money.
Yes.
So what is the importance of precious metals in these times of uncertainty?
Yeah, well, there's something else that we've spoken about banks and short-term and long-term deposits and the difference in interest rates, short-term and long-term interest rates or yields then.
Yeah.
And why banks are vulnerable. Banks are vulnerable because if short-term interest rates go up and their long-term, their return on a longer-term investment do not go up at the same rate, then they are exposed and they can potentially go bankrupt, which happened to Silicon Valley Bank as an example. But there's another problem with banks, and it's called a run on the bank.
Yes.
So what happens is that people, some of the short-term deposit holders, somebody tells them that, listen, I think this bank is in trouble. If I was you, I will take the money out of the bank just to be on the safe side. And the next morning, it's like a stampede, and everybody wants to take the money out of the bank, and they exacerbate the problem. So a run on the bank makes things much worse. And there are many examples in history when there were runs on banks, and a completely safe and sound and well-managed bank that is completely solvent and liquid even in some instances, they got into trouble because there's a rumor doing the rounds that the bank will not be able to repay its short-term depositors.
That's because of fractional reserve banking.
That's a slightly different story. The point is...
But it's because they lend out more than they've actually got.
But they always do that.
I know, but it doesn't make it right.
But you're part of the problem. If you point your finger to banks, then you're part of the problem. Every time you use your credit card, you also participate in this fractional reserve banking system.
So we're all basically causing the problem.
We're all causing the problem. It's the banks and the borrowers that's causing this problem.
But the only ones who profit out of the problem are the banks.
You're also profiting out of the problem.
Well, no, we pay huge interest rates on credit cards.
Yes, but you take this money that you've borrowed and you invest it somewhere else and make a better return.
But most people don't.
But then you're not financially very savvy. Then you shouldn't be doing that.
I agree.
And if you lose money, then it's all your fault.
Yeah, I agree.
Come back to the run on the bank. So quite often what happens is there's a run on the bank, and a well-managed bank that is financially sound may get into trouble because the short-term depositors demand their money back, and if they demand all their money back, the bank simply do not have banks do not have enough money to repay all those short-term depositors, and they get into trouble. So, and this is a bit of a moral dilemma again. So one should ask the question, we've got a healthy bank, there's nothing wrong with it, it's well managed, there's a rumor going around that the bank is in trouble, everybody's removing their cash from the bank, and now the bank is getting into trouble because of that. So should the central bank step in under these circumstances and save the bank because of this malicious rumor, which is completely untrue, doing the rounds? That's an open question. We can debate that. I don't know what the answer to that is, but in practice what happens is that central banks quite often step in and say, listen, this is unfair, there's nothing wrong with the bank, I'm going to save the bank, and I'm going to make sure that the financial system does not collapse because of this rumor, which is completely untrue.
There's a problem with that theory, and that problem is that it's the FDIC who basically underwrite deposits in banks that have failed.
That is a problem.
The amount that they normally cover is $250,000.
Yes.
That's it. But with the Silicon Valley Bank, they cover any amount. Now, the point I'm making is that they only have $128 billion. That's all they've got, the FDIC. Now, you think of the amount of money in deposits that could go bad. We're talking trillions.
Yeah. No, the central bank's got unlimited resources.
But the FDIC are the main
I know,
authority.
that's an insurance company. That's an insurance business. But they can simply get the Federal Reserve. They can get the Federal Reserve just to provide more cash.
And that's called printing money, which means the interest, the inflation is going to go.
That's part of the reason why we have inflation where it is today.
Yeah.
Because of the excesses the past 10 years.
So what we're actually saying, though, Dawie, is that the monetary system as we have it today is very flawed because it's causing the wealth of people to disappear because of inflation.
Now, okay, let's just you make a comment that the monetary system that they have today is very flawed. But I do agree with that. There are many risks in the system that we have today. And the system that we have today is full of risks because of things like, for example, fractional money creation. So banks can take $100 from you, 100 Rand from you, they can lend it out and get the redeposit and lend it out, the redeposit, a number of times.
Yeah.
So $100 or 100 Rands can be used a lot of times, and if the original depositor wants his $100 back, then all this lending and depositing sort of
It's
must be
contagious.
reserved,
Yeah.
or must be reversed suddenly,
Yeah.
and it pulls the system down.
Yeah.
So that's the downside of the system that we have today. And of course, there are always opportunities for all sort of shenanigans in the system as well. But the benefit of the system like this, and this is the amazing thing about the financial system and the monetary system that we have today. When there are additional demand for cash in the system, for whatever reason, month end. So I need a lot of cash month end, I need to pay a lot of people, then it breathes, and more cash is created, more money is created. In the middle of the month, where there are fewer transactions happening, the money supply actually contracts. And that's the amazing thing about this.
So it's like a living animal.
It is like a living animal adjusting by the requirements of the financial system and the financial markets and the economy, generally speaking. So it is a good thing. But quite often things can go wrong. And something that goes wrong, typically, is that central banks, and I believe central banks, a good thing that must always happen is companies and banks must go under. It's a good thing for companies and banks to go under, because that creates the opportunity.
Why don't they let the banks go
That
under?
that is the issue. Central banks want to be too good. Central banks want to be this fairy godmother, and they want to make sure that no bank goes under, which is wrong. In a free market system, banks and all kinds of businesses the badly run ones must always go bankrupt. And we must take this capital and put it back into the system for somebody else to get a second bite and trying to get this capital to be more productive or whatever. So this thing that we call the economy is a process actually of continuous renewal and continuous distraction of the old, getting rid of the old and creating the new. And if you don't allow the old and the mismanaged banks and companies to go liquid or go bankrupt, then the new ones won't have an opportunity to be born. So, and quite often under the pressure of politicians, they say, listen, but we cannot allow a company to go bankrupt, a bank, or it doesn't matter what it is, because a lot of people are going to lose their jobs and they're not going to vote for me. And that's wrong. We have to allow for banks to go under, and it's your and my responsibility, if I put my money in a bank, to make sure this is a sound bank. And if I put my money into a company and the company is badly run, the company must go bankrupt and people must lose their jobs. Because somebody else will get the opportunity to use this capital again and create a new company and create a new lot of jobs somewhere else. And that's the key to economic success, a continuous process of recreation and destruction and in the process everybody's getting better off.
Now look, I want to move on to something that to me is very, very important and critical to money as we know it today. And that is the debasement of money. And what I'm talking about here is that up until 1964, when you traded in cash, and I'm talking about not notes, I'm talking about coin, you had in South Africa silver tikkies or threepenny pieces, you had silver sixpences, you had silver crowns, you had a gold half sovereign, and you had a gold sovereign. And in 1964, that stopped. And in 1965, the only silver coin that remained was the 1 Rand coin, which was 80% silver. All the others went to nickel. So instead of having the value that you were trading when you bought something in the coin, you now had a worthless piece of metal replacing that, except for the Rand coin. And what has happened since 1964 is that now if you look at the money we use in South Africa, for example, I think the lowest effective coin that you use is a 2 Rand coin, because effectively it's like the old tikkie from way back in the 1960s because of the debasement of money and inflation. Now, if you had money backed solely by gold and silver, which meant that there was a complete limit as to how much money could be in circulation, wouldn't that be better for the man in the street look, having it where you've got fractional reserve and you can create as much money as you like works well for people who've got a lot of money, because they go to a bank and they say, look, I've got this building here, I want to get a loan, and then they buy something else. So they can do a huge amount of money using this fractional reserve debased money system. But your average guy, who might be someone who works in the garage, or someone who works as a cleaner or works in a restaurant, their value is completely debased because they aren't able to buy into that fractional reserve money.
Yeah.
Over to you.
A couple of things that okay, let's just understand what this word debasement, what it means.
Yeah.
Now, debasement simply means that whatever currency or money that you're issuing is losing its value. It's losing its value relative to something else.
Yeah.
It can be losing its money relative to gold, as an example. Mm-hmm. It can be losing its money relative to groceries. Doesn't matter. And what we're experiencing worldwide today is a lot of debasement happening with a lot of currencies.
Yeah.
And then we call it high inflation. So that is what debasement, what it means. A second thing is that you made a comment that certain kinds of money in South Africa has become worthless. And I think that's a very unfair comment. Because I can point to you to some currencies in the world that is really nothing. It's not even a piece of worthless metal.
How about the Zim dollar?
No, I can give you. What about the Swiss franc? The Swiss franc doesn't exist in. There's some notes and coins, I know, but most of the Swiss franc is basically electronic money. So it's not even worthless metal. It is just an electronic code.
Yeah.
But it's not worthless. It's certainly not. So the term worthless or value or worth comes down to one thing only, and that is whether people think it's worth something or not.
Exactly. Now, the only reason fiat money, which is what we're talking about here, works is because governments can collect taxes to actually pay the interest on the money that they're borrowing. So it becomes like a perfect circle of lending out, borrowing, and of course using tax to actually pay the interest on.
No, that's not
the money.
Really true.
Okay, go ahead.
Now, the reason why money like the rand maintains some of its value, it's losing a lot of value, but part of the reason why it maintains some of its value is because it is legal tender. Legal tender means by signing that piece of paper called a law, the politicians force us, and that's part of the South African legal framework, the politicians force us to pay our taxes in rands, which means if I'm very wealthy and I only have cattle, as an example, and I must pay taxes on my income, I will be forced to sell some of my cattle for rands in order to pay my taxes. So there's this artificial, if you like, demand that is created for rands because I must pay my taxes in rands. So that creates indeed a demand for rands and artificial demand for rands as well.
Let me put this
So
scenario.
that's part of the reason, yeah.
Yeah. Let me put this scenario to you. If, in a perfect world, every 1 rand, every 10 rand was backed by gold, for example, that would actually stop the banking collapses.
No, it will not.
Tell me why.
All right. So you have to make a distinction between two kinds of money in a modern.
I'm not talking about fractional reserve. I'm talking about where it's no longer backed by debt like fiat money. It's backed by a commodity like gold.
But you can have a commodity-based money that also is part of the fractional reserve system. And we had
but the fractional reserve is a problem because that's creating the where you, as you said earlier, you've got this it's like a row of dominoes. If one falls over, it just goes. And it
but imagine. So let's imagine we only function in a cash, a gold cash society.
That's what
there's no credit. Imagine there's no credit because a fractional reserve system is a credit system.
Exactly. Yeah.
So imagine there's no credit. So all transactions will always be in cash. So you will not be allowed to buy a house, or will not be able to buy a house because nobody's gonna lend you money.
Yeah.
That in a way is an example of that. If you want something, you have to pay for it straight away.
So how did it work in the old days?
That's what happened in the old days.
You didn't buy a house.
You didn't buy very expensive stuff because you did not have money unless you can borrow money somewhere. And that is what a fractional reserve system is. It's a system that is based on credit.
Right. So the benefit is the ability to buy a house,
For example.
as opposed to where you've got something backed solely by gold or silver.
Yes. But what
you're
you can
limited to
have,
the purchases you can make.
you can have a gold-based system.
Yeah.
Okay, let me just explain how there are two kinds of money. The first in this process of money creation, the first step is always to create some base money. Now, in the current system, that base money is what economists call M0 as an example, or M1 depending on your
That's
definition.
cash use.
It's basically cash and deposits of banks at the central bank.
Yeah.
So it's not necessarily cash only, it can be electronic money as well.
Yeah.
So, but central banks create, in an old gold system, your base money would have been the actual stock of gold. That is your base money. Then you take your base money and you put it into the economy, and people use this base money as money, but they also use that to create credit.
Right.
And that is called the money creation process by the private sector typically.
Right.
So, a good example in today's money, the central bank will create the first $100 and give it to the bank. Of course, it's a process. They give $100 to the bank. The bank will take the $100 and lend it out, and it will be deposited back, and lend it out, and deposit back, and lend it out. And that is the money creation process. But the original first $100 was created by a central bank, and the rest of the money creation process, what you call the fractional reserve system, is created by the banks and the bank's customers. Not only the banks and the bank's customers. And they make this $100 more, in a way. So if the central bank removes this $100 out of the system, then this whole credit system that was created, the whole thing will collapse suddenly.
Yeah.
So those are the two kinds of money. Base money as a first step, and then after that, whatever the private sector does with that. Now, this base money can be either money that's created out of nothing, like rands or dollars or whatever the case may be, or it can be gold. It doesn't really matter. So a fractional reserve system is not a system that is only applicable on so-called fiat money. It can also be based on, say, money, metal-based money like gold.
Now, isn't one of the risks with this, you've got basically, when you talk about money in the bank, you've got two forms of money. You've got money that's been put in there for a fixed term at a fixed interest rate, which allows the bank to go and invest it in different things. And you've got money which is rather like in savings accounts and credit accounts and stuff like that, which is money on demand.
Very good question.
Yeah, so in other words, that the banks charge fees for actually holding that money for the people who've got the savings account or whatever. Now, what's happening in today's banking system is that the banks are no longer just using the money that's in a fixed term deposit. They're actually going to the savings accounts and check accounts and using that money illegally, basically, to go and invest and try and make money on short-term money.
Why is that illegal?
Well, because it's a money on demand. If everybody wanted their money, go ahead.
Yeah, okay. So what's money? There are many definitions for money, but the generally accepted definition for money is anything that is generally accepted as money is money.
Yeah.
It doesn't mean much, this definition, but money can be anything. So how do we, as economists, how do we measure money? And we've got certain definitions for money. We call very short-term money, like M0, we call it M0.
Yeah.
Slightly longer term, M1, M2, M3. In the case of South Africa, we like to use M3. M3 consists of cash and notes, deposits of banks at the central banks, short-term deposits, medium-term deposits, and long-term deposits. You add them all together, and we call that M3.
Right.
But what about government debt instruments? Because the question is, what is money? If I've got a long-term deposit, for example, which is part of money, it's part of M3, so I've got a long-term deposit, but I'll have to wait 10 years before I can get access to that. I can sell it in the short term for a discount perhaps, but that is, according to the definition, part of money.
Right.
But what if I hold a government debt instrument, a bond as an example? I can also go and sell that and convert that into money. So that is also money in a way. So maybe there's a M4 also. What about my house? I can also sell my house, convert that into money. It's going to take a little while, maybe there's M5 as well. So the problem with money is, where do you draw the line? Where's the end of money? But anything can eventually be turned into money. And that is what we do.
Yeah.
Where we've got actual cash, we've got deposit of banks at the central bank, we've got short-term deposits, they can all be converted into money. We've got medium-term deposits, we've got long-term deposits, we've got government bonds, we've got stocks and bonds, we've got property. So where's the end of money?
Let me put this to you. If I've got a savings account, let's say I've got 1,000 rand in it, okay, which means that because it's a savings account, I should be able to go into the bank and draw the 1,000 rand.
Yes, that's the agreement.
Without any problems at all. If I've got a fixed deposit where I'm earning interest and it's lasting for a year, it's only on the date of expiry that I can draw that money.
Yes.
Because if I draw it earlier, the bank is going to penalise me for taking it out before the time.
Yes.
So what I'm saying in effect is that, I hear what you're saying about money, but the banks are only supposed to use money that's in for a certain period of fixed time to do investments and trade or do whatever they do to make money. But what they're now doing is they're using this money which is on demand, in other words like check accounts and savings accounts. They're actually using that credit to go and do the same as they do with fixed deposits, which is not in basically a strictly right way of
so what he's saying is that banks are taking your short-term deposit, your savings account, your overnight savings account,
and investing it,
and the long-term stuff.
Yeah.
Yes, that's what banks do.
Yeah, but it from a moral perspective, it's not right.
No, it's not immoral. Of course it's not immoral. They've been doing it forever.
It doesn't make it right, though.
No, there are laws to do that.
Yeah.
Because the law says that banks are not allowed to take all their short-term deposits and put it into long-term assets. They do it, and they get into trouble because of that.
Well, that's the point I'm making.
Yes, of course they get into trouble.
Okay. Now, Dawie, there's so much we could talk about on this subject. What I'd like to move to now is the future of money. Because I think we've basically gone into the trips and the traps of money as we know today. Now,
all right, guys, that was stage one. Let me just turn this thing off. Here we go. All right, that was part one of my discussion with Dawie about money, and it was obviously talking about money in context as to what we've been using in the past. And tomorrow night we're going to be talking about money looking at the future. And we're going to be talking about things like, in South Africa, this new money called PayShap, and how it will lead to the central bank digital currency. So we're talking about an evolution in money and how that will impact you, whether it's a good thing or whether it's a bad thing or whatever. But that is part two, and whoopsie, I'm doing my little trick here, guys. I can just see Mark laughing his head off right now. Okay, I got it. And just for the record, next week we've got live streams lined up as per usual. Monday night I'm going to, as I said at the very start, be talking about my trip to South Africa. It'll be a very interactive thing. I'll be answering questions in the side chat. I'll be playing some videos that I took during my trip, so you get a good feel as to what's happening in South Africa. Tuesday night I'm talking to Dr. Peter Hammond. We're going to be talking about things in South Africa, including the Eskom fiasco. And then we got obviously other live streams going through to Friday. So we're all back on board. Daily emails are going out again, and videos will start rolling as per usual. There's some really big developments happening on that side. All right, guys, I'm going to wrap this live stream up with, I think, seeing that I'm back in Australia and I had an amazing time in South Africa. Here's a shout out to Marlena. Thank you, Marlena. She's a great host. And here comes Hier Bly Ek Boer. And don't forget, part 2 tomorrow night, Saturday night at 8 p.m. Johannesburg time, The Future of Money with Dawie Roodt. Here we go.
Meer as 61.000 van ons voorvaders het op die grens van ons gesterwe, sodat ons vry kan wees. Die is my land, die is my reg, hier is ek boer. Van stof is ek gemaak en sal ek terugkeer. Die Bybel is die woord waaruit ek leer, soos die grond op die aarde. Hier bly ek boer. Soos 'n dief in die nag sal die vyand kom, maar hier bly ek staan en ek draai nie om, want jy maak my nie bang nie. Hier bly ek boer. Die is my land waarvoor ek sal veg. Die is my bloed, my sweet, my reg. Die is die plek waar my voorvaders leef. Die is my land, hoor wat ek jou sê. Die is my land, wat my mense voor. Hier bly ek boer. Soos 'n blaassam in die somer wat vreugde bring. My oupa wat maniekiero kon sing, soos hy stap deur die lande. Hier was hy boer. My wortels lê